yourself, and please try to keep your remarks concise so we can create more opportunities for other people to participate. If you have any questions about anything related to today's conference, please find any of my colleagues around the room or outside who are wearing a white lanyard. They'd be happy to help you. With that, let me get us started by introducing Federal Reserve Chair Jay Powell, who will offer opening remarks. Thank you.
Golf clap, golf clap, golf clap. Golf clap. You're golf clapping. You must golf clap, golf clap.
Thank you, Trevor, and good morning. I'd like to add my welcome to everyone. Thanks for being here. Thomas Laubach's research and his broader support of the FOMC helped us better understand monetary policy, and it is fitting that this work will continue today in his name. Thank you to the authors of the papers, to the discussants, and to our panel participants, and thank you also to Trevor and his team for organizing this conference. A whole lot of work went into bringing us together. As in our last review, the 2025 review consists of three key elements: this conference, Fed Listens events at the reserve banks around the country, and policymaker discussions and deliberations supported by staff analysis at a series of FOMC meetings. In the current review, we will reconsider aspects of our strategic framework in light of the experience of the last 5 years. We will also consider possible enhancements to the committee's policy communication tools regarding forecasts, uncertainty, and risks. In 2012, the FOMC first codified our monetary policy framework in a document entitled the Statement on Longer-Run Goals and Monetary Policy Strategy, which we refer to as the Consensus Statement. The language in the opening paragraph, which has never changed, articulates our commitment to fulfilling our congressional mandate and to explaining clearly what we're doing and why. That clarity reduces uncertainty, improves the effectiveness of our policy, and enhances transparency and accountability. As chair, Ben Bernanke led the committee through the creation of that initial consensus statement, adopting a 2% inflation target and outlining our approach to achieving our congressionally assigned dual mandate. The framework laid out in that document broadly aligned with best practices for a flexible inflation targeting central bank. The structure of the economy evolves over time, and monetary policymakers' strategies, tools, and communications need to evolve with it. The challenges presented by the Great Depression differ from those of the Great Inflation and the Great Moderation, which in turn differ from the ones we face today. A framework should be robust to a broad range of conditions, but also needs to be updated periodically as the economy and our understanding of it evolve. From 2012 to 2018, the FOMC voted at each January meeting to reaffirm the consensus statement, in most years without substantive changes. In 2019, we changed that practice, conducting our first ever public review, and said that we would repeat such reviews at roughly a 5-year interval. There's nothing magic about a 5-year pace. We believe that frequency is appropriate to reassess structural features of the economy and to engage with the public, practitioners, and academics on the performance of our framework. Several of our global peers have adopted similar approaches to their framework reviews. At the time of the last review, we had been living for about a decade in a new normal characterized by proximity to the effective lower bound, with low interest rates, low growth, low inflation, and a very flat Phillips curve. If I could capture that era with one statistic, it would be that the policy rate had been stuck at the lower bound for 7 long years following the onset of the global financial crisis in late 2008. After liftoff in December 2015, we were able to raise the policy rate only very gradually over a period of 3 years to a peak of just 2.4%. 7 months later, we began reducing it, leaving the rate at 1.6% in late 2019, where it would be when the pandemic arrived a few months later. Policy rates in other major advanced economies were even lower, in many cases below zero, and in all such economies, inflation regularly ran below its target. The sense at that time was that when the economy next experienced even a mild downturn, we would be right back at the lower bound, probably for another extended period. The post-financial crisis decade had demonstrated the pain that that could bring. Inflation would likely decline in a weak economy, raising real interest rates as nominal rates are pinned at zero. Higher real rates would further weigh on job growth and reinforce downward pressure on inflation and inflation expectations. Reflecting these concerns, we adopted a policy to make up for persistent shortfalls from the inflation target, an approach that was common in the extensive literature on the risks associated with the lower bound. Given the downside risks to employment and inflation from proximity to the lower bound, and the need to anchor longer-term inflation expectations at 2%, we said that following periods in which inflation has been running persistently below 2%, we would likely aim to achieve inflation moderately above 2% for some time. We also concluded that policy decisions would be informed by assessments of shortfalls rather than deviations from maximum employment. The change to shortfalls was not a commitment to permanently forswear preemption or to ignore labor market tightness. Rather, it signaled that apparent labor market tightness would not, in isolation, be enough to trigger a policy response, unless the committee believed that, if left unchecked, it would lead to unwelcome inflationary pressure. This change reflected our experience with long expansions that featured historically low unemployment amid low and stable inflation, suggesting that a policy approach that carefully probed for the maximum level of employment could bring about the benefits of a strong labor market without risking price stability. In the years just prior to the pandemic, for example, unemployment was at multi-decade lows while inflation ran below 2%. By December 2019, estimates of the longer-run unemployment rate had fallen sharply. The use of shortfalls acknowledged that a combination of low inflation and low unemployment does not necessarily pose an adverse trade-off for monetary policy. The economic conditions that brought us close to the lower bound and drove the changes in our consensus statement were thought to be rooted in slow-moving global factors that were likely to persist for an extended period, at least until our next 5-year review. And that might well have been the case had the pandemic not intervened. The idea of an intentional moderate overshoot proved irrelevant to our policy discussions and has remained so through today. There was nothing intentional or moderate about the global inflation that arrived a few months after we announced our changes to the consensus statement, and I acknowledged as much publicly in December 2021. We fell back on the rest of the framework, which called for traditional inflation targeting. Through the end of 2021, FOMC participants continued to forecast that inflation was likely to subside fairly quickly in 2022, with only a moderate increase in our policy rate. That projection was consistent with other central banks with different frameworks and the vast majority of forecasters. When the evidence showed otherwise, we hiked 525 basis points over a period of 16 months. The most recent data suggests that 12-month PCE inflation was 2.2% in April, far below its 7.2% peak in 2022. And in a welcome and historically unusual result, as this room knows, this disinflation has come without the sharp increase in unemployment that has often accompanied a campaign of rate hikes to reduce inflation. The economic environment has changed significantly since 2020, and our review will reflect our assessment of those changes. Longer-term interest rates are a good deal higher now, driven largely by real rates, given the stability of longer-term inflation expectations. Many estimates of the longer-run level of the policy rate have risen, including those in the Summary of Economic Projections. Higher real rates may also reflect the possibility that inflation could be more volatile going forward than during the inter-crisis period of the 2010s. We may be entering a period of more frequent and potentially more persistent supply shocks, a difficult challenge for the economy and for central banks. While our policy rate is currently well above the lower bound, in recent decades we have cut the rate by about 500 basis points when the economy is in recession. Although getting stuck at the lower bound is no longer the base case, it is only prudent that the framework continue to address that risk. While the framework must evolve, some elements of it are timeless. Policymakers emerged from the Great Inflation with a clear understanding that it was essential to anchor inflation expectations at an appropriately low level. During the Great Moderation, well-anchored inflation expectations allowed us to provide policy support to employment without risking destabilizing inflation. Since the Great Inflation, the U.S. economy has had 3 of its 4 longest expansions on record. Anchored expectations played a key role in facilitating these expansions. More recently, without that anchor, it would not have been possible to achieve a roughly 5 percentage point disinflation without a spike in unemployment. Keeping longer-run inflation expectations anchored was a driving force behind establishing the 2% target in the 2012 framework. Maintaining that anchor was a major consideration behind the changes in 2020 Anchored expectations are critical to everything we do, and we remain fully committed to the 2% target today. In the current review, the committee is engaged in discussions about what we have learned from the experience of the past 5 years. We plan to complete consideration of specific changes to the consensus statement in coming months. We're paying particular attention to the 2020 changes as we consider discrete but important updates reflecting what we have learned about the economy and the way those changes were interpreted by the public. In our discussions so far, participants have indicated that they thought it would be appropriate to reconsider the language around shortfalls. And at our meeting last week, we had a similar take on average inflation targeting. We will ensure that our new consensus statement is robust to a wide range of economic environments and developments. In addition to revising the consensus statement, we will also consider potential enhancements to our formal policy communications, particularly regarding the role of forecasts and uncertainty. As we have been reviewing assessments of the 2020 framework and of policy decisions in recent years, a common observation is the need for clear communications as complex events unfold. While academics and market participants generally have viewed the FOMC communications as effective, there is always room for improvement. Indeed, clear communication is an issue even in relatively placid times. A critical question is how to foster a broader understanding of the uncertainty that the economy generally faces. In periods with larger, more frequent, or more disparate shocks, effective communication requires that we convey the uncertainty that surrounds our understanding of the economy and the outlook. We will examine ways to improve along that dimension as we move forward. So let me end by saying thank you again for being here. We've been looking forward to us. All of us have been looking forward to being with you today and having these conversations that will occur over the next 2 days. These discussions will help broaden and deepen our thinking about these issues, and they're critical to the success of these reviews. Thank you very much.
Wow. Big numbers. Really big numbers.
Thank you very much. We are going to just roll right into our first.
So there is more to go. This is apparently an important thing that they do. They said this was one of the 3 pieces they use, I don't know, in the review. It's early, guys. My brain's still waking up. Also, I cannot stop looking at these numbers. Holy moly. Just before Chair Powell spoke at 8:40, this actually officially began at 8:30. Chair Powell did the keynote opener at 8:40, 10 minutes later. So at 8:30 when this began, U.S. core PPI came in actual minus 0.4%. This is bullish for crypto. The forecast, oh geez, you're very excited. The forecast, 0.3%. That is a whopping 0.7 difference between actual and forecast. That is the biggest discrepancy I think I've seen. Clearly, that is down month over month from the 0.4% in the month before, I guess, March. PPI coming in the same 0.5% down. I'm going to have to do a little research. I just saw this as well. I did do a little research here on when was the last time there was such a miss. And this site actually helping me out with that, cryptocraft.com. It's free. They don't pay me. I don't make any money on it. I don't even know if they make money on it. Maybe through ads. You can see my ad blockers denying them that money. But great site. You guys are asking what it is, cryptocraft.com. Let me turn this woman back on, see what she has to say. I think this conference is going to have some actually important stuff. I guess really quick as well, people were saying, Chair Powell never says anything. It's always the same. It's just on repeat. And you're not wrong. You're not wrong. But that's largely by design. So the Fed, if they do anything, they typically do not speak when they don't need to, when they don't have anything to say. So the Fed has largely not done much when it comes to interest rates over the last 2 years. And we had one cut, 2 cuts. And so there is no reason for the speech to be mixed up. When there is a mix up in the speech, that is a literal identifier that there are changes targeted. And so the Fed does a good job of avoiding that in order to not steer forward guidance in the wrong direction, etc. Let me put this back on while I collect my thoughts.
Participation in welfare losses stemming from gender and racial discrimination. So I think with that said, Aisha is going to get us started.
Okay, get us started.
And you'll have 30 minutes. Finish at 8:20.
Maybe it's a debate.
Thank you for the invitation to this exciting event. I would like to see my slides if possible.
3 months in a row. PPI down. Great start to the year.
My job here is to start our discussion on the employment side of the mandate, to define, measure maximum employment, and link it to price stability. As you can imagine, it's not an easy task, because while the FOMC set a clear target and linked that target to a specific indicator on the price stability side, the maximum employment mandate remains relatively ambiguous. And you can see it here in this paragraph that I took from Longer Run Goals and Monetary Policy Strategy. So this statement is going to be my guide throughout my presentation today. So I'm going to go over key aspects of this definition, the broad-based and inclusive side of it, being not directly measurable, changing over time due to monetary factors, and its assessment depending on shortfalls from maximum employment, which is based on an analysis of a wide range of indicators. And while doing so, I'm going to use an approach that I found useful over the years to connect directly to each aspect of this definition. So this is a flow approach that I'm going to bring in. As articulated nicely in an older paper by Blanchard and Diamond, the flow approach brings in additional accuracy and richness to understanding of the labor market. And as a result, it provides us a unified framework to be able to put together this wide range of indicators. An example I'm going to give you is going to be talking about unemployment and participation dynamics to highlight the common and distinct forces that shape both of them. And the second is it directly connects to the underlying labor market mechanism. Job finding and job loss are inherently subject to different frictions, and it's going to help me to identify these frictions. In addition, the non-monetary factors that make it harder to specify a certain level for any indicator will be better understood by using this approach, which is going to connect us to the price stability mandate. Moreover, we are able to distinguish the mechanisms, distinct or common, that will help us support a broad-based and inclusive goal. Having said that, even though I started by saying there is not a clear metric.
Having trouble following her, honestly.
Start thinking about employment to population ratio.
I feel like she's not only going to talk about DEI, because now she's doing unemployment term versus participation term. Like, I think she might have started on the wrong foot.
We enter a recovery, it starts recovering because unemployment rate starts going.
I think she's going to say things that matter. Sorry. Rip me. That's not like me.
Through the participation margin. And this simple identity.
How is the volume? Is she just like quietly in the background? That'd be right.
Something that's very close to one. Changes in participation will be more important even than changes in unemployment.
If the volume's not too loud, I want to know what you guys think about these PPI numbers. It is so early, my brain is not used to processing information. Or maybe it's even better than ever at processing information. I can't get past it. I need to know. Something that we should keep in mind is this is April data, to my knowledge. It's month over month. They don't have marked. It's clearly not May yet. We're midway through May. April data does tend to be odd here. Maybe not for PPI specifically, but like for instance, I think yesterday I saw some numbers going around about budget surplus for the month of April, blah, blah, blah. April is when the government gets paid. The government really only gets paid in April. It gets paid a little bit in October for extended filings. So the government always runs a surplus in April, but it's when the big boys, the biggest of boys, gets paid, and so some numbers can be skewed. I'm looking at these graphs here. Look at these graphs, and I will admit that it seems, at least PPI, this would be the third cool reading in a row. March, April, May. Wait, it can't. This is May's reporting. So April, March, February? Question mark? Something like that. This is kind of hard to read in that sense. The forecast is just so missed. I'm really curious as to what maybe the experts are going to say about this. What do you guys think? It's too early. I need coffee too. PPI going to be good or bad? It's extremely good. In fact, I would argue it is maybe the best reading ever outside of maybe like March 2015 over here, when we got a -5 and we were looking at, what, 1.1? Maybe back here, November 2010. Like this is down there. They forecasted 0.3. It was actually negative 0.4, so that's a 0.7 spread. Previous was 0.4, so that's come down even the forecast. In general, we would consider this good. We consider this good for crypto. We consider this good for the Fed, for favorable interest rate changes. Price is going down. Well, be careful about that, Andy, because literally I would say no. Literally I would say no. Maybe month over month we can argue something like this here. But in general, inflation is not prices going down. It's simply just when inflation goes down, prices are just moving up slower. Prices almost never reverse. I don't think they ever will in our lifetimes, honestly. What is this? This is an interesting flow chart. What is it? She's saying something here. This is definitely something. Look at this.
So if there are
No.
changes in
Come
turnover
back.
in the economy, some of the indicators will tell us
will.
different things. So we have to think about their impact. But what's the most important thing here?
I'll pull up the chat again.
is that even though being employed
Early
and
in the day.
unemployed
What's up,
is
Vivi? I don't know about best.
in a static sense,
Rate cuts drop price at first.
for the labor force
They
participation,
drop the
it has
price of money.
going forward. Because an unemployed
You work in manufacturing, you have not seen any
10 times
notable
more likely
cancellations for the remainder of the year. There's a dip in new
So
orders.
this mechanism
Sold out for the year. Nice.
will
Good to see, dude. You know, I was saying I can't believe you guys are awake. I'm impressed. I'm proud of you for getting up early and joining us. I appreciate that. But you reminded me so politely that you guys have real jobs. You said, we have real jobs, Tom. Of course we're up. Touche, my friends. Even more impressive. Pat yourselves on the back. Honestly, all of my real life friends who have what you would say is normal jobs, they're not YouTubers. My pre-YouTube friends, they all have been laid off in the last 3 months. 3 months or maybe 6 months at most. So if you haven't, pat yourself on the back. You were actually doing pretty great. Show NASDAQ chart. NASDAQ, sure, but NASDAQ they haven't opened, right? It's like 9:30. Dude, I'm never up this early. I'm a joke. I'm a joke of a human. I'm never getting up this early. NASDAQ futures are open. Thursday, May. Not a lot going on there. Got me some. There you go. Not a lot going on there, though.
Then it starts going down. And the difficulty is that
What's Powell doing now, Cheese? He just spoke.
And as you can see, entry and
This
exit
woman coming with all the graphs, bro. Oh, I love graphs. I'm like immediately hypnotized when I see graphs.
It's actually pushing participation up early in recessions as entrants enter through unemployment. And
I think she might be saying
stop
intelligent
because
things. Maybe we should
people tend
listen.
to increase their search intensity.
I don't think she's
But
talking about
the
DEI.
component that's directly related to job finding and job loss that moves people within the labor force is unmistakably pro-cyclical. And interestingly, even though the recovery from the COVID recession was way faster than the recovery following the Great Recession, the dynamics are very similar in both cases. So moving on to this idea, but what about the unemployment rate? Because now we link job finding and job loss to participation pressures. What about the unemployment rate? We all know that job finding and job loss are very important, but given this unified framework, I could actually look at the determinants, the flow origins of the unemployment rate as well. And as you can see, the red one, job finding and job loss, are again the most important drivers. It's about 2/3 of the fluctuations in unemployment. But interestingly, in this case, opposite of the prevailing narrative, the entry and exit actually amplifies fluctuations in the unemployment rate. One interesting thing going back to economic mechanisms, as you know, the unemployment rate went up from 3.4% to 4.2%, and there was a fear that this was the signal of an impending recession. But if you actually look at flow origins of this, unlike previous recessions where job finding and job loss margin created this stark increase, contributed starkly, there was no such increase in what I refer to as the soft landing period. So this tells us that it's not only the increases in the unemployment rate, but the flow origins are also important to evaluate what to expect from that. So now that I have these cyclical components, I can go back and look at the importance of unemployment and participation cycles and see how they are evolving over time. So I'll take the same equation and I will look at the cyclical evolution. So this gives me my favorite indicators, the unemployment cycle, because the recession opens a hole in the economy. And then we try to get out of that hole, increase employment, by reducing the unemployment rate and by creating employment stability through the participation margin. So the participation part is really important. It's at least two-thirds of the upward pressures in employment coming from that margin. But what's important for real-time policy considerations is that it lags. It lags around 9 months. It takes time to create this employment stability even after job finding and job loss prospects improve for workers. And one thought I had before looking at this was the participation recovery was very slow after the Great Recession because it was a very slow recovery. But if I look at the recovery from the pandemic, the same lead and lag structure actually applies. Even during brisk recoveries, we should expect this about 9-month delay in the pickup in the participation rate. And the evolution of participation actually followed this. We have seen meaningful increases in the participation rate after we hit the 3.4% in the unemployment. So then what about the inclusiveness of this? Because I'm still looking at that. I don't have time to show that, but when you do this for different demographic groups, the same mechanism applies for all. So it's always the employment stability, not the entry and exit. But perhaps, surprisingly, the leg structure is also very similar. Each group have very similar leg structures to the aggregate economy. So this has the implication that we could shift our focus from entry of marginalized groups to employment stability of all workers. And the mechanism behind this is the same. It's job finding and job loss prospects improvement. So now, what about price stability? One definition of maximum employment is the highest level of employment that does not compromise price stability. So now I want to take this flow approach and start thinking about the price stability part of it. So far, all I have shown you is how the economy progresses without telling you when we start seeing price pressures or where the natural rate should be. So I want to think about the natural rate of unemployment as the unemployment rate which is consistent with stable level of inflation, following Friedman's definition. And it's obviously as clear as also clearly specified in the statement, driven by non-monetary factors, and it's going to be time varying. While in the 70s, the idea was that 4% is the full unemployment rate, we have learned that there are big fluctuations in the natural rate of unemployment coming from slow or fast-moving factors. So I want to think about two different kinds of non-monetary factors. The first one I will refer to as U-bar. These are secular trends. They are easier to project because most of the time they are related to slow-moving demographics. So one thing about aging, we can stop it and it's deterministic. So it helps us understand these trends really easily.
Demographics.
But then there is the second temporary labor market shifts. The difficulty about this is even though it's tempting to change the indicator that you are focusing on, from cycle to cycle, different labor market shifts happen. Mismatch increases on the job search intensity or changes in recruiting behavior of firms, they all appear in different cycles. So now what I want to do is to offer you a summary measure that is based on unemployment, that's consistent with stable prices, which is going to be a proxy for all these labor market disruptions. But I will use the secular trends as my anchor. It's going to help me identify this, because if I were looking at 1975, I would be able to see that because of all the demographic effects, all the baby boomers entering the labor market, there was an upward shift in the unemployment rate, which makes 4% an unreliable target. So obviously, once you have this, you could summarize inflationary pressures in the economy by defining the unemployment gap. Where is unemployment relative to the natural rate of unemployment? And this gap is going to be affected by where we are in the business cycle, as well as monetary policy.
Tesla.
So I want to estimate U-star, which is obviously not an observable indicator. But what's observable is my anchor U-bar. And you could also think of it being consistent with the long-run projections in the S&P that Chair Powell just has shown us. So I want to do this in the context of a new Keynesian Phillips curve, which allows me to have a forward-looking view of inflation. Nominal wages will be sticky, and when they are reset, they will be reset taking into account where the agents will expect the labor market to go forward. And when I use this new Keynesian Phillips curve, I will be able to decompose total inflation into two components. The second part is going to capture the temporary supply shocks, changes in productivity, markups, supply disruptions, while the first one, which I refer to as the underlying inflation, will link labor market to inflation. The first component, obviously, is inflation expectations, long-run inflation expectations, but the second part will take this unemployment gap and moderate it through the slope of the Phillips curve. And this kappa obviously will be an important parameter. But what I want to take away from this is it's not only the contemporaneous output gap that matters, it's also the expectations about future unemployment gaps that's going to be a determinant of inflation. So we're going to estimate the natural rate of unemployment following the seminal work of Thomas Laubach in 2001. We are going to bring in the flow-based measure of the trend unemployment rate, median CPI, 5 different measures of labor compensation, and inflation expectations will tell me two things. One is how anchored they are in the long run. That's an important part of underlying inflation. And the second is how they vary in the short run, which is going to reflect what people expect for the unemployment gap to be in the future. So these will be enough for me to identify the natural rate along with the underlying component of inflation. So this is the natural rate of unemployment in black, but let me first anchor you with the red line.
Flipping through charts looking for the good ones for you guys.
And as I mentioned, there was a big increase in secular trend, and this mostly follows the demographic structure of the US labor market, as well as the increase in female labor force participation. And currently, it's pretty much around the level that the longer run projections of the SEP is at the median SEP is at 4.2%. But what's more important for price stability is these increases in the natural rate. As you see in the Great Recession, there was an increase. And we discussed a lot what are these factors. And mismatch recruiting intensity, UI extensions, house luck, these were all explanations that came up. And our model, even though it's agnostic on the sources, is picking up this disruption. But it's not big enough to create a big decline in the unemployment gap, which is still remaining very high for a very long time because of the persistent unemployment rate. When we look at the pandemic, there was even a bigger increase to around 7%, which only subsided slowly. This time, factors are different. This is related to increase on the job search intensity. It's related to increases in reservation wages and extension of unemployment insurance benefits early on. But this also coincided with a brisk recovery in the unemployment rate, which brought the unemployment gap to negative very early on during recovery. And it became an important driver of the underlying inflation. So you can see the CPI in dashed lines, and pi star is the long-run inflation expectations. But the underlying inflation, that's the part driven by
Maybe I'm too dumb, but it looks good.
Current and future labor market conditions, has started to pick up earlier, and it has been relatively persistent. And it still remains elevated, accounting for the remaining of the inflation that we are currently seeing above the 2% target. And also, I can give you an estimate of the supply shocks on the right-hand side. You can see that the big swings are driven by this, while the persistent component is related to the labor market. So what about disinflation? Because when we try to think about the relationship between unemployment and inflation, we often want to change our slack indicator, or we often want to change the slope indicator. But here, what I'm doing is I'm just using this forward-looking way of looking at inflation, and I'm only using a single slope. But the soft landing episode makes it harder to reconcile what has happened, because we have seen a substantial disinflation with very minimal increase in the unemployment rate. So if you look at this period, both in terms of CPI and underlying inflation, as well as a summary measure of wage inflation extracted from 5 different measures, bulk of the disinflation happened between 2022 Q2 and 2024 Q2. And after that, disinflation slowed down. If you look at expectations of unemployment from professional forecasters, that's on the left-hand side, that's when they started expecting unemployment rate to go up. And in the survey of consumer expectations, a Michigan survey, the fraction of households that expected unemployment.
Hold up real quick. Wow, we have 1,400 viewers on YouTube. Wow, well done, guys. Make sure you're smashing the likes. Subscribe to the channel. Jump in our Discord, discord.gg/TomCrown. We don't have nearly enough likes. It's an embarrassing amount of likes. It's too low. It's too low. I know this lady is kind of hard to follow for me. Look, we have 1,000 votes on the poll, but only like 200 likes. Come on, guys. Come on. I know this lady's a little hard to follow. I think she is saying some good stuff. I'm having trouble following her. She's throwing out a lot of equations. You guys know I love equations and graphs, so I'm trying to stay locked in here. My mind is still on the PPI numbers I came in. Huge upset. I'm basically in the background just looking for input on I don't know if we're missing something on these numbers, why they're so crazy, etc. But keep smashing the likes, subscribes. I'm going to be chatting in the chat. I don't want to talk over these presenters too much. We're certainly not going to be here for the whole conference. I think this thing goes all day. And he goes like, yeah. And into tomorrow, no thanks. Ooh, continental breakfast. We should be there for that.
I favor. Should I be using vacancy to unemployment ratio, or should I be thinking about changes in the slope? So one last thing about what I learned about vacancies when I looked at the flow approach, again, goes back to a simple accounting identity. Employment evolves because people separate from their jobs and people get hired through vacancies. QT here is the job fill rate, ST is the separation rate. So the vacancy rate in that case can be written as a function of growth rate of employment. It could be payroll employment or household, doesn't really matter. Separation rate and the job filling rate. So the employment growth rate is about 100 times smaller than the separation rate. So most vacancies that we see are there to handle turnover in the economy. It's clear because employment grows by a couple of 100,000 where we have millions of vacancies. So any changes in job filling rate and separations rate will affect the vacancy rate in the economy. Put differently, an economy with high turnover should have a high vacancy rate to handle that turnover. And I think this is really key to understanding what happened with vacancies in this cycle. So I'm going to show you a simple counterfactual. The blue line here is the actual vacancies, and it picked up pretty much with inflation. That's why it has become an indicator that we started relying on to understand inflationary pressure.
I'm really having a hard time following her. Could do this.
Thomas Laubach.
She won't speak forever, I promise.
Today in his name. Thank you to the authors of the papers, to the discussants, and to our panel participants. And thank you also to Trevor and his team for organizing
Trevor
this
is
conference.
the man.
A whole lot of
Trevor
work
is.
went
You
into
can tell.
bringing us together.
No genius.
As in our last review, the 2025 review consists of 3 key elements: this conference, Fed Listens events at the reserve banks around the country, and policymaker discussions and deliberations supported by staff analysis at a series of FOMC meetings. In the current review, we will reconsider aspects of our strategic framework in light of the experience of the last 5 years. We will also consider possible enhancements to the committee's policy communication tools regarding forecasts, uncertainty, and risks. In 2012, the FOMC first codified our monetary policy framework in a document entitled the Statement on Longer-Run Goals and Monetary Policy Strategy, which we refer to as the Consensus Statement. The language in the opening paragraph, which has never changed, articulates our commitment to fulfilling our congressional mandate and to explaining clearly what we're doing and why. That clarity reduces uncertainty, improves the effectiveness of our policy, and enhances transparency and accountability. As chair, Ben Bernanke led the committee through the creation of that initial consensus statement, adopting a 2% inflation target and outlining our approach to achieving our congressionally assigned dual mandate. The framework laid out in that document broadly aligned with best practices for a flexible inflation targeting central bank. The structure of the economy evolves over time, and monetary policymakers' strategies, tools, and communications need to evolve with it. The challenges presented by the Great Depression differ from those of the Great Inflation and the Great Moderation, which in turn differ from the ones we face today. A framework should be robust to a broad range of conditions, but also needs to be updated periodically as the economy and our understanding of it evolve. From 2012 to 2018, the FOMC voted at each January meeting to reaffirm the consensus statement, in most years without substantive changes. In 2019, we changed that practice, conducting our first ever public review, and said that we would repeat such reviews at roughly a 5-year interval. There's nothing magic about a 5-year pace. We believe that frequency is appropriate to reassess structural features of the economy and to engage with the public, practitioners, and academics on the performance of our framework. Several of our global peers have adopted similar approaches to their framework reviews. At the time of the last review, we had been living for about a decade in a new normal characterized by proximity to the effective lower bound, with low interest rates, low growth, low inflation, and a very flat Phillips curve. If I could capture that era with one statistic, it would be that the policy rate had been stuck at the lower bound for 7 long years following the onset of the global financial crisis in late 2008. After liftoff in December 2015, we were able to raise the policy rate only very gradually over a period of 3 years to a peak of just 2.4%. 7 months later, we began reducing it, leaving the rate at 1.6% in late 2019, where it would be when the pandemic arrived a few months later. Policy rates in other major advanced economies were even lower, in many cases below zero, and in all such economies, inflation regularly ran below its target. The sense at that time was that when the economy next experienced even a mild downturn, we would be right back at the lower bound, probably for another extended period. The post-financial crisis decade had demonstrated the pain that that could bring. Inflation would likely decline in a weak economy, raising real interest rates as nominal rates are pinned at zero. Higher real rates would further weigh on job growth and reinforce downward pressure on inflation and inflation expectations. Reflecting these concerns, we adopted a policy to make up for persistent shortfalls from the inflation target, an approach that was common in the extensive literature on the risks associated with the lower bound. Given the downside risks to employment and inflation from proximity to the lower bound and the need to anchor longer-term inflation expectations at 2%, we said that following periods in which inflation has been running persistently below 2%, we would likely aim to achieve inflation moderately above 2% for some time. We also concluded that policy decisions would be informed by assessments of shortfalls rather than deviations from maximum employment. The change to shortfalls was not a commitment to permanently forswear preemption or to ignore labor market tightness. Rather, it signaled that apparent labor market tightness would not, in isolation, be enough to trigger a policy response unless the committee believed that, if left unchecked, it would lead to unwelcome inflationary pressure. This change reflected our experience with long expansions that featured historically low unemployment amid low and stable inflation, suggesting that a policy approach that carefully probed for the maximum level of employment could bring about the benefits of a strong labor market without risking price stability. In the years just prior to the pandemic, for example, unemployment was at multi-decade lows while inflation ran below 2%. By December 2019, estimates of the longer-run unemployment rate had fallen sharply. The use of shortfalls acknowledged that a combination of low inflation and low unemployment does not necessarily pose an adverse trade-off for monetary policy. The economic conditions that brought us close to the lower bound and drove the changes in our consensus statement were thought to be rooted in slow-moving global factors that were likely to persist for an extended period, at least until our next 5-year review. And that might well have been the case had the pandemic not intervened. The idea of an intentional moderate overshoot proved irrelevant to our policy discussions and has remained so through today. There was nothing intentional or moderate about the global inflation that arrived a few months after we announced our changes to the consensus statement, and I acknowledged as much publicly in December 2021. We fell back on the rest of the framework, which called for traditional inflation targeting. Through the end of 2021, FOMC participants continued to forecast that inflation was likely to subside fairly quickly in 2022, with only a moderate increase in our policy rate. That projection was consistent with other central banks with different frameworks and the vast majority of forecasters. When the evidence showed otherwise, we hiked 525 basis points over a period of 16 months. The most recent data suggests that 12-month PCE inflation was 2.2% in April, far below its 7.2% peak in 2022. And in a welcome and historically unusual result, as this room knows, this disinflation has come without the sharp increase in unemployment that has often accompanied a campaign of rate hikes to reduce inflation. The economic environment has changed significantly since 2020, and our review will reflect our assessment of those changes. Longer-term interest rates are a good deal higher now, driven largely by real rates, given the stability of longer-term inflation expectations. Many estimates of the longer-run level of the policy rate have risen, including those in the Summary of Economic Projections. Higher real rates may also reflect the possibility that inflation could be more volatile going forward than during the inter-crisis period of the 2010s. We may be entering a period of more frequent and potentially more persistent supply shocks, a difficult challenge for the economy and for central banks. While our policy rate is currently well above the lower bound, in recent decades we have cut the rate by about 500 basis points when the economy is in recession. Although getting stuck at the lower bound is no longer the base case, it is only prudent that the framework continue to address that risk. While the framework must evolve, some elements of it are timeless. Policymakers emerged from the Great Inflation with a clear understanding that it was essential to anchor inflation expectations at an appropriately low level. During the Great Moderation, well-anchored inflation expectations allowed us to provide policy support to employment without risking destabilizing inflation. Since the Great Inflation, the U.S. economy has had 3 of its 4 longest expansions on record. Anchored expectations played a key role in facilitating these expansions. More recently, without that anchor, it would not have been possible to achieve a roughly 5 percentage point disinflation.
Just so you guys know, this did already happen. Chair Powell already spoke. There was another lady speaking. We decided as a group not to listen to it, but to re-listen to Chair Powell so we could maybe digest a little bit more of what he said. He did say a lot in this, more than usual. Other breaking story coming in today, which I did see when I woke up. Coinbase hacked. I know a lot of you may be tuning in, freaking out, because anytime we hear an exchange hacked, we freak out. That's okay. However, guys, take a breath. Coinbase was hacked, meaning they bribed a staff member to basically get user data. So no, your coins aren't in trouble. No, you didn't get wiped out in your account. To my knowledge, there's no danger there of that. Basically, going forward, and this was always the case anyway, but going forward, you're probably going to get more scam emails pretending to be Coinbase, more scam phone calls pretending to be Coinbase, texts, etc., as that information now in the hands of people nefarious, bad people willing to spend 20 million on it. But it is really interesting that they were added to the S&P 500 yesterday. Everybody says maybe it was Monday or 2 days ago. I don't even know. This week, and almost the next day, this happens. Pretty, I don't know, man. 2025, it's just not real. None of this is real life. Although passwords and private keys were not compromised. Okay, cool. Passwords not, though you should change your password anyway. Affected data included sensitive data such as names, addresses, phone numbers, emails, exactly, masked bank accounts, and identifiers, as well as last 4 digits of social security numbers, government ID images, wow, great, account balances, and the company said cyber criminals bribed and recruited a group of rogue overseas support agents to steal Coinbase customer data and facilitate social engineering attacks. So even they're coming out and saying, you're basically going to get more phone calls, more texts, more emails. Remember, guys, Coinbase will never call you. Ever. They'll just never, ever call you under any circumstance. If someone calls you, says they're Coinbase, they're not. Doesn't even matter if their phone number comes up and says Coinbase. Hang up and then maybe try calling Coinbase's official number on their website, right? You will get emailed by Coinbase a lot. This is the tricky part. However, never, not just Coinbase, any exchange, everything in crypto, never click links through your email, even if it says it comes from Coinbase.com. Do not click a link to log into Coinbase via your email. If you see something, you get an alert and it says you need to log in right now. Something, maybe we detected a login from Singapore, blah, blah, blah. Close the email, open up your browser, use your bookmark, log in, and see when you log in if you can find that notice. Do not ever, especially if it seems urgent, ever log in or ever click a link to try to log in to an exchange in crypto. You will get phished. You will lose your account. That's 101, guys. Real easy. I know Brian Armstrong came out and said, because there's 20 million ransom. I know he came out on Twitter and basically said, we aren't going to give you 20 million. We'll give 20 million to whoever helps us arrest you or something like that. I'll try to find the tweet here in a second, but I just wanted to run through that. Someone news talking. Let's go back.
That we would have unemployment price pressure. We're at all-time high from the unemployed into employment around this period. And so is there something in the information between the E to E flows relative to U to E flows that could potentially be important about underlying shocks that are hitting the economy, and then moreover, how those shocks might propagate through future wage and price pressure? And so that's what I'm going to try to talk a little bit about now. So what are some of the stories that people have put forth of why you're getting churn in the labor market relative to drawing people in on the margins? And I'm going to give you 3 stories. We could probably think of a couple more as well. One of which is there's sectoral productivity shifts. In particular, some sectors get more productive during this time period relative to other sector. People are going to migrate from the unproductive sectors to the productive sectors. That's going to have a flavor of a regular productivity shock that we would have in our model. You would get some wage increases and potential price increases coming from the fact that people are doing churn if some sectors are more productive than others. 𝐂𝐡𝐚𝐫𝐭, she didn't even mention it, has some separate work about amenity shifts in the labor market during this time period. Work from home, and if work from home is an amenity, that actually puts downward pressure on wages because people are going to be compensated in ways that are not monetary, and potentially downward pressure on inflationary prices, inflation going forward. So if the churn is coming from work from home, we might not be worried about future.
Let's play this quick.
Hey everyone, I want to make you aware of a disturbing email that we received recently at Coinbase.
This is the CEO, Brian Armstrong, of Coinbase.
It was a ransom note demanding $20 million in Bitcoin in exchange for these attackers not releasing some information they claim to have obtained on our customers. Now, we like to do things transparently here at Coinbase, and so I'm going to respond publicly to these attackers by saying, no, we are not going to pay your ransom. In fact, I have a few next steps in mind that I'm going to share at the end of this video. But for the rest of you watching, wondering what happened, we did an investigation here, and these attackers have been approaching our overseas customer support agents, looking for a weak link, someone who would accept a bribe in exchange for sharing some customer information with them.
Many people.
Now, our support tools have limited access to customer information. There was no passwords or private keys or funds accessed as part of this.
It's important.
But customer support agents do have access to personal information like name, date of birth, address, etc. And attackers still want access to this information because it allows them to conduct social engineering attacks where they can call our customers, impersonating Coinbase customer support, and try to trick them into sending their funds.
I didn't even listen to this. I didn't even listen to this yet. I'm playing it for the first time. Exactly what I just told you.
To the attacker. Now, unfortunately, they were able to find a few bad apples. Our systems are designed to mitigate the impact of something like this, so less than 1% of our monthly transacting users had their records accessed, but this is still unacceptable. And I want to tell you what we're doing about it. Unacceptable. Their records accessing users had their records accessed, but this is still unacceptable. And I want to tell you what we're doing about it. So first, any customers that were socially engineered as a result of this incident, we're going to reimburse them. There's more details on our website, on our blog post.
How could they ever do
about
that?
the reimbursement process. You can read more there.
How could they ever verify? There's so many social engineering attacks going on all the time. I get them. I get from Coinbase on emails that aren't even connected to Coinbase, daily emails from Coinbase. Like, AKA, I daily get phishing emails that are pretending to be from Coinbase. So how could they ever say they're going to reimburse people?
Any customers who have been impacted by this or have been notified at this point. Number two, we're hardening our systems around customer support to make something like this much more difficult in the future. And third, we're actually relocating some of our customer support operations as a result of this. But the last step is maybe the most important, which is that instead of paying this $20 million ransom, we're turning it around. And we're putting out a $20 million award for any information leading to the arrest and conviction of these attackers.
That's goated.
For these would-be extortionists or anyone seeking to harm Coinbase customers, know that we will prosecute you and bring you to justice.
Goated.
And now you have my answer.
Goated. Brian Armstrong. Not always goated, but that was pretty damn goated, guys. There it is from the CEO himself. Let's get back. I do have this guy sped up because I want to catch up.
Wage and price pressure. And then there's a third story, which I'm going to spend a little bit more time on the next slide, is that there's an inherent identification problem with inflation and vacancies per se, in the sense that the inflation itself could cause churn in the labor market. In models with nominal wage rigidities, when inflation comes, real wages fall, and then you might get workers resorting to try to escape their nominal wage rigidity. And the data during this period, and I'll kind of allude to some of it, kind of showed stories 2 and 3 might be more important than story 1 during this type of period. So let me just kind of mention that third story a little bit more in depth. This kind of stuff that I've been working on with Hassan Afrouzi and Andres Drenik and Andres Blanco in a paper we have called, A Theory of How Workers Keep Up with Inflation. It's a very literal title. But in that, it was really just what happens when you shock an economy with inflation in a general model of labor flows with nominal wage rigidities. And in that model, as I said before, real wages fall. Churn is going to occur in the labor market as people are going to try to escape their nominal wage rigidity. That's going to create an incentive for firms to post more vacancies. There's lots of workers churning. You're going to get vacancy durations going up as people are going to be wanting to find a job quicker, so the job finding rate's going to increase, the job filling rate is going to fall. You're going to see lots of patterns we have in the data that don't result from any other underlying labor market shock except the inflation itself. Now, we know the inflation is not exogenous. It was caused by stuff. But even in that narrow kind of component, in that partial equilibrium sense, that's where the identification comes from. And I'm going to show you that identification problem is going to be more severe in periods when we think aggregate supply shocks are going on. And so my second comment is going to be, can we use these labor market flows to potentially learn about the underlying labor market shocks in the economy? So This is a picture I show, and I'm going to flesh it out a little bit more in the next few slides. So this is the vacancy to unemployment rate in the United States going back to 1950. So up to 2000s, it is JOLTS data. Prior to 2000s, it is the help wanted ads, from the newspapers. And you will see that there are 8 spikes over the 1950 to 2024 period in the vacancy to unemployment rate. 4 of those spikes are going to look like traditional hot labor market, moving along a beverage curve kind of stories. During these periods, the unemployment rate was falling sharply as the vacancy rate was rising. During this period, nothing else was interesting was going on in inflation. It kind of looks like the story that when we want to put these vacancy to unemployment rates in our new Keynesian models, this kind of looks like what they're trying to capture during those periods. But there's 4 other periods: 1974, 1979, 1951, and the current pandemic period, where the vacancy to unemployment rate was at relatively high levels. The unemployment rate moved somewhat during this period, but not a huge amount during these down periods. But yet, the inflation rate was relatively high. And so what I'm going to do next is I'm just going to try to correlate in a very simple way whether shifts in Phillips curves, which we usually think occur when supply shocks are around, are correlated with shifts in beverage curves when the vacancy to unemployment rate is going up, holding the unemployment rate constant. Now, my Phillips curve I'm running here is not going to pass the new Keynesian test in any sort of way. I'm not including any inflation expectations or such. I'm just going to correlate the inflation rate on unemployment and unemployment squared. I want to get a little nonlinearity in there as well. I'm going to take the residuals from that regression.
I like
I'm going to do the same thing with the beverage curve. I'm going to take the vacancy to unemployment rate, run it on the unemployment rate and the unemployment rate squared, take the residuals of those regressions. And I'm going to ask the question, are those residuals correlated? And then the second question, can we get supply shock potentially aggregate supply shocks potentially driving some of that correlation? Here's the correlation in those residuals in the data. What you could see, again, on the x-axis, I'm doing this 2 periods. Again, my limited new Keynesian knowledge knows that there were periods when the Phillips curve was steep or something like that. So I'm breaking it into a 1950 to 1989 period and then a total period. It doesn't matter on the period. That's all I'm trying to convey here. And what you could see is the periods when the high Phillips curve residuals, or basically high inflation conditional on unemployment, are correlated with high vacancy to unemployment rates conditional on the unemployment rate. And those periods in the upper right quadrant of these graphs are all 1950, 1974, 1979, and this picture doesn't have, but if I included it through the pandemic periods would be in there as well. Now I'm going to do something, again, very simple. I'm going to ask if I project some measure of supply shocks, again, a very naive measure of supply shocks, just oil price movements on as a potential driver of the inflation. Again, I'm not going to driver is a strong word, correlate of the inflation. And ask if I isolate the variation in inflation that is coming from oil price movements, do we still see this relationship? And the answer is yes. So what I'm basically showing you now is just the regression of those residuals on each other, where I instrument in the second column for the inflation with the oil price movements. And these numbers are kind of big. These are basically saying like a 10% movement in the inflation rate moves the vacancy to unemployment rate by about 0.2 percentage points, depending on the columns you're going through.
Stuff's very smart.
The average vacancy to unemployment rate is about 0.65. So these are kind of big movements in the unemployment rate, in the vacancy to unemployment rate over time here. So there's some periods of time where the vacancy to unemployment rate might be picking up something else relative to our notion of a hot labor market going forward. Okay, 5 minutes, I'm almost done. So what I'm going to do in my last few minutes is going to ask one last thing, and again, this will be relatively quick. Okay, so there's certain types of flows that might be informative of shocks. In particular, E to E flows relative to U to E flows might be some moment we could look at to get a sense of the churn in the labor market by drawing new people in. The third comment is going to be, can we use other types of moments, and particularly the wage data itself, to help us learn about the underlying shocks? And again, this picture has been around now in our discourse among policy and academics for a little while, but in real time, it is something we might have looked at a little bit more. This is the real wages from the Atlanta Fed, just for the CPS data I just downloaded from the Atlanta Fed wage tracker index. The median wage in the United States, they had nominal, I just deflated by the CPI. Started in 2016, ran this forward. And what you could see is during this period of time, when the vacancy to unemployment rate was going up quite sharply, real wages were falling. And if you take a look at where real wages are today for the median worker, is not too far where they were at the beginning of the inflation period. They fell and they've rebounded, but they're rebounding back to kind of the levels they were at the start of the inflation. And yet, real wages have a trend. And so relative to trend, we are still below trend. Now, maybe the trend changed, okay? But in that world, if there was something like a productivity shock that reduced the trend, that should have also had some downward pressure on wages. So using these wage metrics could help us a little bit to think about, in real time, what is the underlying shock? I'm going to show one more moment, and then wages of those who are churning might actually rise. They didn't in this data. So this is, again, from the Atlanta Fed. I worry about the switcher data in the Atlanta Fed because they miss all the people who change houses at the same time they change job. The ADP data, which I have the micro data for that, you get slightly higher growth for the job changers, but still, it's not like the job changers were getting a boom. It looks like the job changers were just relatively keeping up with inflation, where the job stayers were actually taking real wage declines. And this is my last one. The sectoral data also provides us some information of potential underlying shocks. The story of sector reallocation, you might see flows moving from one sector towards another sector in the data. Here, I mean, again, using combination of JOLTS and the Atlanta Fed data, you can see there is variation across sectors. But the first thing that sticks out for me, every sector had massive increases in vacancies during this period, and every sector had real wage declines during this types of period, consistent with the inflation itself eroding away the real wages and maybe potentially generating some churn in the data. I should mention that the real wage declines for the top of the wage distribution have been much greater than at the middle and the bottom. And again, if we think working from home is something that hits more the top of the wage distribution than the bottom, that could also potentially explain some of these patterns. And 𝐖𝐈𝐆𝐍 has some work on that as well. Okay, so that's my comments. So, the labor market flows, I just want to echo what 𝐖𝐈𝐍 was saying. The labor market flows can be informative of future inflationary periods. She focused on the U* part. I'm saying, just in general, there's another moment, the churn in the labor market relative to, among the EDE switchers, relative to who we're drawing in on the margin could also be informative. Periods of aggregate supply shocks, which we all tend to think there was at least some component of an aggregate supply shock in this recent period, tend to be associated with both shifts in the Phillips curve and the shifts in the Beveridge curve. The real wage decline generates churn itself, and the labor market responds to that churn. And then the wage data and the other sectoral data could shed some light on some of these potential underlying mechanisms. Okay, that's all I got.
United. Wow, look at this United chart. This United chart, holy shit, down 50s, 60% here since April. But check this out. Actually, not that terrible looking. You put an ascending channel on it, and it looks like it's about to reach the bottom of this channel. Bounce there, and it's just where it was.
Come back to that. Also, I have a reminder that we're not going to be taking questions today from the esteemed members of the press who have joined us here. There are microphones in the room, so before you ask your question, make sure that you've received a microphone. And although it doesn't say this in my instructions, I actually think it would be nice if you introduced yourself before you ask your question so we can all hear from who's asking the questions. I'm going to take 2 or 3 questions at a time, then give our presenters a chance to respond, and then I'll take some more questions. So with that, Larry, you had your hand up already, Adriana, and Mark, why don't we...
COINBASE down on the news here.
To Joe after.
Could see 220 fill the gap.
So Adriana, you can go and then give...
Employment is one of the most vacuous terms in all inflation dynamics.
This guy's
you can't have a
speaking to the mic
as a measure of objective.
Nobody can hear him.
It has to have the word sustainable in it, and it has to be related to the inflation objective. Now, you get away from that in a while. It has to be a zero slack concept. It has to be a zero slack. And of course, there are many of them, but we could look at many of them. We can't look at everything, but that's what we have to look at. So you get away from the maximum employment, fair enough, and get to that point. But it's very important. I won't win this battle. They'll always refer to maximum employment. The previous statement looked at minimum sustainable unemployment. Got it right?
Thank you, Adriana Kugler, Governor of the Federal Reserve Board. So congratulations on a great paper. There is a lot to like about it. I think something that was really helpful was how you really embrace all 3 definitions of U*, the bottom-up approach with flows data, the NIRU, consistent with the stable prices, and the FERU, which is the full employment rate of unemployment by using the V2U as well and incorporating that.
Jerome Powell right next to
lots to like. I had some concerns about how you move along with this, especially in terms of measurement.
So in terms of measurement, I had 3 concerns. So it's one question, but 3 different measurement issues. Wow. So I'm sticking them all in. So first of all, your measure of inflation expectations is really reliant on the forward-looking nature of inflation expectations, but yet we know from recent literature, including the paper that will be presented next, including some of the literature that I cited in my speech at Princeton, that consumers and businesses really rely on recent experiences, right, to understand where the inflation expectations stand. So I'm just wondering how you would address that tension in the model, because you're relying on forward-looking inflation expectations, yet what we know from the recent literature is that what really counts is these short-term experiences and short-term inflation expectations in terms of forming inflation expectations even in the long run. The second issue that I was concerned with is the fact that you use CPI to measure inflation. And we know that, in particular, the CPI relies a lot on housing inflation, which has been incredibly persistent, and that would likely push up the U-star. And that takes me to the third issue, which is when you move to that second step of getting from the trend to U-star and from your flows data to measuring U-star, then you get something very, very odd, which is that we get a negative U-gap for the most recent period. Somehow you must be overestimating U-star. Something that you don't do when you get to that second step is actually to use the labor force participation flows. And so that concerns me, because you started the talk by saying how important these labor participation flows are, and yet you don't use them in that second step. So again, I'm worried about really biasing up your estimates of U-star, which in turn lead to this very odd result that you have a negative U-gap all throughout the past few years. So thank you.
Really heavy access.
Marco Del Negro, New York Fed. So great presentations and great discussion. I have one really quick question. So Aisha, when I look at the picture of the level of unemployment that is consistent with 2% inflation, my reading of that picture, the gray line, was that level right now is about 6%, so that we have to bring unemployment up to 6% to achieve 2% inflation. And the gist of Eric's presentation was, as my reading, very different, and in particular the picture on the real wage suggests that the labor market and the real wages are still below trend, so that the labor market is not that hot. And I find it hard to reconcile the two stories. I wonder if you can help me. Thank you.
Okay, yeah, let's turn to the panelists now.
Okay, first of all, Larry, in terms of maximum employment, I think it's a holistic definition, and that's what I try to reflect. But one thing I try to do is how far you can go by just thinking about job loss and job finding that are main drivers of the unemployment rate, and I use unemployment as my aggregate proxy for those forces by showing that even though we tend to think of participation as additional slack, it doesn't necessarily have to be that way when we think about the cyclical pressures on it. And I think I totally agree with your statement, but one issue with declaring a full unemployment level is obviously the ongoing trends. Adriana, a couple of comments. First of all, we use short-term inflation expectations along with long-term inflation expectations as well, and they are the reason why we are seeing the U-star elevated. We have tried different measures of inflation. I think what the model is interpreting as the remaining persistent inflation is it's related to what we are seeing in the labor market. And one thing Eric showed is what happened to real wages, and you have seen that they actually started going up after this time period. And in terms of Marco's question, no, it doesn't mean that we have to increase unemployment to 6% because as I have shown, the future component, the determination that we will reduce inflation even if unemployment has to go up to 6% was behind the disinflationary process. So in that case, when you look at when the inflation progress stalled, it was when those expectations of hard landing actually declined. So that's the connection that I see. But I've shown you that job fill rate, matching efficiency.
Let's just skip this up to current time. So a lot of people tuning in right now asking about Coinbase, I guess. This stream finally hitting the algorithm. You guys are just waking up. So the story is this. Coinbase was hacked. However, take a breath, relax, not a big deal. You don't need to freak out. You don't need to do anything. So Coinbase, basically they're saying there were foreign support agents who essentially sold or worked together to steal customer data. So this is similar to the Ledger hack that we had a few years ago, meaning the keys, the assets are not compromised. There's no asset loss that we're aware of. There were no passwords even compromised, so you should change your password. But what was leaked, I believe they said it's about 1% of their users, emails, names, KYC data, which is like not great. Not information you want hackers really to have, but there is no real risk here. Unless something changes or develops in the story, there's no real risk. The only thing that you need to be aware of or really understand about this, well, there's two, but the most important to you is you're going to receive more calls, emails, texts, I don't know, pigeon mails, singing grams, pretending to be from Coinbase, more phishing attempts. Remember, Coinbase will never call you under any circumstance. Anyone who calls you saying they're from Coinbase is lying, is scamming. Coinbase will email you. However, they will too. So will hackers. So will these phishers. So do not click the links, even in emails you know that are from Coinbase. Do not click the links. Go directly to the site. Confirm the email or whatever you get. Same goes with texts, guys. Do not click links at all when you're in crypto. Go directly to the source. Not the end of the world. The only other thing that you should know is kind of interesting timing. Coinbase was added to the S&P 500 index. And what is this, like 24 hours later? I think it was more like 72. But like 24 hours later, now this happens. I don't know. Seems kind of insider trade-ish to me. Maybe that's just me. Maybe I'm having my tinfoil hat on. Let's go back to this quick.
Also, part of the reason they have sort of trended higher is it's just easier to have one. So I'm curious how you think about how that's changed over time, and does that have any effect on how you think about this? Thanks.
Yeah, just a couple comments on Eric's point. So first on the real wages, I mean, whenever you have a supply shock, you're going to have a fall in real wages. That's going to be true regardless of the model that you have. Second thing is on the using a kind of a spot market measure is maybe not the best way to think about people that are professional in that. They're not going to go out and immediately look for a new job or quit or anything. We may hope that because it's a long-term relationship, our wages come up later, which kind of is what you showed. And the last thing is on the shift in the beverage curves because of the supply shock. I mean, that was one of the things that Andrew Vergara and I were looking at.
Bev curve. That's something I can get behind. Give me a Bev curve.
Very steep portion of a nonlinear beverage curve. And then you have some matching inefficiency.
Do you guys hear that? Maybe that's just my headphones. Every once in a while, there's like a tear or a scratching noise. It might be my wireless headphones.
What Andrew and I did, we took the Blanchard and Summers estimate of matching inefficiency, plugged it into ours, and basically it didn't really change the quantity effects because you're just on these vertical portions. And shifting up a curve when you're looking at the vertical portion doesn't really change the fundamental results.
On vacancies, I agree. There's a change in technology in terms of where vacancies were. In the Great Recession, actually, there was a shift. But I don't think there was a big change in technology of vacancies relative to 2019. But this speaks to the point that I was trying to reflect. If we want to think about a different measure in a Phillips curve framework, it's going to have its own natural rate. An economy with high turnover will have a high V over U to accommodate that. So we can't just get rid of this concept of the natural value of that indicator. A trend, such as you mentioned, would actually drive vacancy to unemployment ratio to a different level. But
So
I don't think we have had enough changes relative to the pre-pandemic in terms of the technology. Even though if you go back, obviously there were changes. Thank you.
I'm just going to kind of echo one thing. You know, the cyclical variation should be relatively robust to the trends. The long-term relationship, you know, I think that is true. If my booth deans are listening, my real wage and my nominal wage chugged along at about 3% per year through the whole thing. My real wage, you know, the whole contract had shifted down. And I do want to just say you know, when we see these E/E rates shift, we went from like something, I don't know, 2.3% of us churning per month to something like 2.6 or 2.7% of us churning per month. You know, so that's a big change, but you know, 0.4 churning per month integrated over, you know, a 25-month period, we're only getting the extra churn we're seeing in the population is only like 6 to 8% of us kind of going through. So there was some, even though many people are in these long-term relationships, there was some on the margin that actually churned a little bit more. I just want to make sure we keep the magnitudes, even though the percentage shifts are a lot, the actual amount of people that were doing these churns were you know, modest in scope, even though they were big in percentage shifts.
Interesting that stocks fell on this weak inflation data. On the weak inflation data, that's unexpected.
One of the features of the pandemic recovery was the fiscal policy activism and the fact that because unemployed people were being made whole, the unemployment rate was not really, or any other labor market indicators were not capturing well demand shortfall. How do you think about bringing in fiscal policy if it remains activist in the future, and from a perspective of a policymaker trying to set the right interest rate? It seems to me they're focusing only on sort of measures of slack based on flows or however you want to define them, might be missing the fact that demand might still be strong if unemployed people are made whole.
Hi, Julia Coronado from Macro Policy Perspective. So I don't have a particular question. I reiterate the concern about upward trends in vacancies. But I think your idea that there was sort of a level shift in the pandemic and since then is a perfectly reasonable conclusion. Yeah. But I just want to say that I love this work. I love this work and the discussion. I think it's incredibly valuable to connect the mandates and think about the dynamics of the labor market in a way that can be measured in real time. This could be so, so valuable for Fed communication and understandable by the public. So congratulations on this work. I love it all, and I love this discussion, and I think this is really important advancement.
Doubt understood by the public. Giving us way too much credit, lady.
Yes, Silvana Duke, San Francisco Fed. Maybe a question for Eric, but feel free to weigh in as well. In terms of the three sources, the three sources of shocks, maybe like sectoral productivity or amenities, changes in amenities or nominal rigidities, I was wondering if you don't also have to think about worker heterogeneity. So you showed heterogeneity across industries, but not everyone can work from home, for instance.
What's up, Darian?
And if I'm not mistaken, I think the real wage behavior behaved differently at the lower end of the skill distribution than higher skilled workers.
I'll start with Sylvain's question. It's true, and it's actually consistent with the fact that high-wage workers got increase in their job values through amenities. This allowed them to probably save some money, commute time, and there's a lot of evidence on that, spend more time with their families, also be able to move to areas where housing costs are smaller. So there is definitely job value increase for high-skilled workers, while for workers with lower educational attainment, since there was not that opportunity, there was higher wage increases. I think it's consistent with this mechanism. But now that that reallocation is pretty much over, we are back to the good old job ladder, where job-to-job transitions create real wage increases. So that's consistent with this idea of 𝐢𝐴 being evaluated. In terms of fiscal policy considerations, I mean, one thing that we always do is we always try to think about what's different this time. And when we thought about entry and exit, we've specifically focused on the COVID recession because we thought the dynamics would be different. With the exception of the lockdowns, where there was a way of exit that was followed with entry, the dynamics of participation looked the same. Having said that, we have seen real increases in reservation wages, especially for workers with lower education. So we see fiscal policy affecting willingness to work along that dimension. But in terms of participation dynamics, at least the forces that are driving it, things look very similar.
So,
and thank you, Julia. Of course.
I'll just one thing on Sivan's quick. You know, there is heterogeneity across the wage distribution. Real wages at the bottom have now just kept up on trend. So if I show those gap kind of relative to, so even though nominal wages were higher, if you kind of put it in real wages and relative to trend, they're right back on trend. Relative to the top is not. And in models where, you know, we could calibrate with data, the bottom just churns more for some of the reasons we were just talking about. We're in long-term relationships, we don't churn more. And so that elasticity of when you have an inflation shock and you want to reallocate, it is much easier at the bottom where the long-term contracting is less, more spot market-like than it is at the top of the distribution. And that's exactly in our model. We can match the distribution by just for exactly the same reason of the elasticities of different wage groups.
And if I may add, I mean, in terms of remote work as an amenity, its cost, its effect on productivity, the jury is still out there. We don't know if this was actually reducing the values that the firms were getting relative to what the workers are getting. So that's something I think we will have to figure out as time passes, because it's possible that providing this amenity was also costly for the firms, and that triggered changes in productivity. So I think that's an open question that I think time will tell us.
Great. Okay, well, I think I'm going to let that be the last word. This was a great first session, so I think we should give a round of applause to our great presenters. And we're now going to have a half-hour break.
Hey. That's good, just in time. So a lot of people still tuning in, guys. Coinbase hack, okay. First things to know. I know it's like the bajillionth time I've said it. Nothing to worry about directly. Your funds are okay. They're safe, to our knowledge. Basically, it's like the ledger hack of a few years ago, where emails, personal info, account info, outside of passwords and keys to your coins were compromised or basically sold off, being held ransom for like 20 million. Basically, you're going to get more phishing emails, calls, etc. Just be more vigilant. I mean, I'm getting them every single day anyway, so I don't know if I'll be able to get more, but if you're not getting them, maybe prepare to start getting them, etc. Chairman Powell did speak. I'm like trying to figure out exactly what he said, though. This is some things to read through or sift through. There's some talk. He did use the words, basically, like, look at our average inflation rate, right? He said, it might be appropriate to consider adjustments to average inflation targets, and the average inflation target's 2%. However, then he also talked about remaining anchored, expectations anchored, longer run expectations, and fully committed to 2%. So a little conflicting, unless I'm missing something, kind of waiting for the jury to come out on that. I guess that the central bank is in the process of making adjustments to its policy framework. Thanks, Wall Street Journal. That was uninformative. That was uninformative. Terrible article. So yeah, we covered Chairman Powell. He spoke it was not bad. The other speakers were very hard to understand or follow. I don't know. Maybe because it's early, maybe not. You feel more dumb, that's okay. So many bears in the chat. I don't know, man. Whenever Chair Powell speaks, people come out of the woodwork they just come out of the woodwork. The crazies, baby. Anything interesting now? No, I mean, the main interest. So Chair Powell speaking was important. It had meaning. He did say things kind of outside his norm to what he usually does. But the big story today is still PPI and core PPI coming in negative 0.7% under forecast. Both these readings, wild. These are some of like the biggest discrepancies that we have seen on these readings. That would be the third in a row where PPI is negative. I do want to caution you guys. I know some of you are going to hate this, but we got to live in reality when we're thinking about markets. That's 3 in a row. This is April's number, month over month. So inflation, cooling, right? Into April. What happened in April? Well, that's the uncertainty. That's when this trade policy, the Liberation Day, tariffs and trade policy, etc., that the Fed is specifically talking about, came into action. So here's what we got to look for. Those numbers are great. And had none of that ever happened, we'd probably be very soundly on track to cuts. However, these are all the readings before, the lead up into all of these big mix-ups and uncertainties and changes and tariffs and such. If only none of that had happened, that'd be great. What we want to see is these numbers continue to May, June, July, into the summer, etc. We want to see this keep going. They're going to tell a story of what is happening under the hood with trade policy in the U.S. and tariffs. And we're going to see that over the next few months. It would be amazing to continue to have these good cooling readings, but time will tell. I'm not the most confident that we will, but I welcome being wrong, right? I'd welcome being wrong. I want things to go well. I can't believe we streamed at 8:40 in the morning. This conference does continue for like hours more. We're not going to watch the whole thing. Hours more. Chair Powell already spoke. He doesn't, to my knowledge, doesn't speak again. He just is sitting there in the crowd being a G. Let me see. Do they have? Yeah, here's the schedule. We're on this little break now from 10:15 to 10:45. I guess they're ahead of time because it's 10 minutes early and they're already on break. Moderator. So the moderators are largely, and the speakers are largely Federal Reserve Board presidents. So the woman we had trouble understanding was a Federal Reserve Board. She was a presenter, not president. Federal Reserve Board presenter. What the hell is that? I thought it said president. They're all on the Federal Reserve Board, put it that way. They're people of knowledge, but this goes all the way today. All the way till 4:30 p.m. I actually have to take Beans to the vet today. I know I'm actually very stressed out about it. Professor Beans is an older learned scholar of the charts and of macroeconomics and monetary policy, but she's had some health stuff over the last few years, I've told you guys, and I'm a little anxious about it. A little anxious. Yeah, every time we go to the vet, it's a little anxious in this scenario. Every year she's had a pretty big surgery. I think she's finally maybe at the age where she's too old to have one. So if they want to do it, I don't know. I don't know if it's a good idea. She's 12 now. 12. I don't know. A little anxious about that. So we can't go all day. It does continue into tomorrow. We will be live tomorrow, Friday, baby. Let's go. Today was a special Thursday screening. A lot of people tuned in. I'm actually kind of shocked. Did you like this early stream? Is this a good time? It's not a good time for me, but I aspire to be a morning person. I want to be a morning person. So maybe I'll try to change. Prayers for Beans. Thank you, Crispy. Yeah. Ah, man. You know, people can go F themselves. Not you guys. I love you guys. People can go F off, right? But like dogs, oh man, our pets, do anything for them. I appreciate you guys being here with me this morning, though. Definitely help me stay focused, keep my mind off of that. Not just dwell on it. I'll update you guys tomorrow on how it goes. Fingers crossed that it's just an uneventful vet trip. Though there have not been many of those lately, unfortunately. Raw diet? Oh, I do. We do cook. She eats like a king. You like afternoon better? Me too, Judge. Me too. Helps us be a morning person. That's what I'm thinking. You love the early morning streams. There's not many Cars and Crypto. Mr. Techno Good, you only like it because it's the Tom Crown stream. All right. Right on, bro. I appreciate you. Let's see. Make sure you subscribe to the channel. Join our Discord, discord.gg/TomCrown. If you're looking for an exchange or crypto trading tools, use the links in the video description below. It helps support the channel. You'll get access to the VIP rooms in our free Discord. And if you're looking to really invest in yourself, become a better trader, and really not necessarily even just a trader, but an investor, a person in crypto. If you want to be more successful in crypto, I want to help you do that. Head over to joincrowncrypto.com. Check it out. You can get a free week trial. It's a little bit more exclusive, a little more intimate learning environment. If obviously not for everyone, there is a price tag. If the price tag is not for you, we do have a free complete trading course on this channel. Check out those videos. And it's crazy to me how few of you guys actually watch them. A lot of people tune in for the live streams. A lot of people watch the videos, but there's not a lot of crossover. It's kind of weird. It's kind of weird here. Can I pull this up really easily? Content all. Yeah, here, I'll show you. Videos and lives. Here we go. Real fun, real quick, just a little bonus analytics from our channel here. The crossover, this is mind-boggling to me, all right? 70% of viewers just watch videos. 30% of viewers just watch the live streams. Only 2% crossover between videos and live streams. That means out of every 100 of you here, there's thousands. There's 20 of you who have watched the videos. That's wild. Check out our free course. It's a free trading course. It's the best on YouTube. I don't shill it enough. Put a lot of work into it. This has been over the last few years we've made this. There's so many freaking lessons here. Like, check this out. A lot of these have 250,000 views or more. Look at all these. All kinds of topics. Everything you want to learn. There's 32 of them now. It's forever growing. We're still building on these, even though we have the private group. Check them out. Let's see if we can get that 2% up to 3%, right? I appreciate you guys. I will catch you tomorrow. I'll update you on beans. And that's all for today. Crown out.